Cap Rate Masterclass Part 2. So the age-old question, what is a good cap rate? Well, I wish I knew, but like most things in life, it depends. But typically, the higher the better. The higher the cap rate, the higher the return the property is going to generate. But that also assumes cap rate is a good measure for that type of investment, and we'll get to that at the end of this video. But in academia, you will see some general trends. Where cap rates are determined by things like supply and demand. If, for example, supply is high and demand is low, cap rates will be higher to incentivize buyers to buy. On the other end, if demand is high and supply is low, more people want the same limited number of goods or properties, and they'll bid the price up. That's basic economic theory. The level of risk in the investment also determines what type of cap rate investors may want. If it's a low-risk investment, investors might be comfortable with a very low cap rate. If it's a high-risk investment, they're probably going to want to see a bigger cap rate to compensate for the additional risk in the investment. And then there's interest rates. Interest rates impact financing. If somebody's taking out a loan, if they get great terms and can borrow at a very low rate, they might be able to buy the property at a lower cap rate than they would have during a higher interest rate period of time, but they still might get the return that they want. We go further into that one in a different course called How to Value Rental Property like the pros. And then geography. Geography is related to supply and demand. Some areas there's a lot of demand, some area there's low demand. If you're in New York City, for instance, investors are going to bid those properties up so high that cap rates could be in the 5s, the 4s, I don't know, maybe even high 3s. But in the suburb of a suburb of a suburb in the middle of no man's land, there might be some supply, however, very limited demand. So cap rates would probably be a lot higher in that suburb of a suburb of a suburb of no man's land. Just keep that in mind if you're starting to invest out of town. Just because cap rates look higher there doesn't mean they're good cap rates. They could be the cap rate norms in that area. So those are some trends in academia, and maybe they hold true with some very, very large investments. But when you're dealing with smaller properties, smaller local properties, maybe they have 4 units, 6 units, 8 units, maybe 20 units, these trends don't always hold true, at least based on my experience. As we saw in the previous video, cap rate depends on net operating income, and 10 different investors will calculate different net operating incomes and will thus have 10 different cap rates. From my experience, I've seen so much inconsistency that I have a difficult time extracting meaning from looking at cap rate comps. And because there's so much inconsistency, there's got to be a reason for it. And here's what I used to think the reason was. I literally just thought most people weren't meant to make investment decisions on their own. But as I researched other videos in the market, other online courses, and other online blogs and YouTube videos and all that stuff, what I ultimately realized was that people aren't dumb. And I knew this. But I'm talking about doctors, dentists, people who created successful businesses, people who started successful restaurants. I mean, these people are go-getters, and they're great. However, the resources they have access to online and probably even in person are just inadequate. Most resources are created to get views. They're paid for by advertising. So instead of telling you something that might be a little bit hard, like I'm going to do, they tell you what you want to hear, how easy it is, how simple it is. Look at this simple equation called cap rate, and you can use it, and it'll help you get rich. They're designed to get as many views as possible, to get advertising. They're not necessarily designed to actually help you. And this also assumes that the person behind the course knows enough about the topic. Being popular online and getting lots of likes and views isn't always about what you know. So let's talk about more different types of cap rates. We already talked about how some people forget to include different things when they're calculating net operating income. They underestimate some expenses. They might have missed expenses. And ultimately, the net operating income isn't realistic, so they calculate an inaccurate cap rate. But there's some more things we can look at with net operating income. Not only is it just for 1 year of income and expenses, which year are we talking about? Which year of net operating income? Was it the last tax year when it was recorded? Or is it your first year's projection? How much you think you're going to get in your first year of ownership? Is it the last 12 months? So there is some variation in the timing of net operating income used in this equation. Here are some backward-looking cap rates. As you can tell, this is about stuff that already happened. Net operating income that was already collected, and it's not based on an estimate. It's based on what actually happened in the past. So we have calendar year. That's from January to December of whatever year, and this usually coincides with taxes. You use your net operating income from that calendar year to calculate a cap rate. Then we also have the T12 or trailing 12. That's when you would calculate your net operating income for the prior 12 months. And the reason you might do this over a calendar year, although these two might coincide, is what if you're looking at a property in July? Maybe you'll look at the June numbers all the way through the July numbers in the previous year. That's an off year. You're going from 1 year to another year, and it's middle of the year. So you have the last 12 months of net operating income. That's more recent than the previous calendar year when the taxes were recorded. And then you have your T90 or trailing 90. That's trailing 90 days. That's 3 months. So another thing you can do is you can take the last 3 months of actuals, add up the NOI for the last 3 months, and multiply it times 4 to get what it would be for 12 months if the property was assumed to operate for an entire year at the same performance that it got over the last 3 months. Let's look at these in more detail. Here's a chart. On the left, we have net operating income, and this line represents the net operating income for whatever month you see at the bottom. On the far left, we have January 2018. On the far right, we have July 2019. So we have 16 months of net operating income reflected in this line here. And just a general trend, you can see that the net operating income is getting higher, which means something happened at some point that resulted in more net operating income. Maybe they raised rents, maybe they renovated a unit and now they're collecting higher rents. Whatever it is, it's making more money over the last few months than it has over the last 16 months. So looking at trailing 90, this is the one where you take the last 3 months and you multiply it times 4. The sample you take comes over the last 3 months, and as you can see here, the net operating income is pretty high, and you're only capturing the high net operating income. You're not capturing the lower net operating income on the left. So when you take this higher net operating income for 3 months, multiply it times 4, you're going to have a pretty high net operating income, at least compared to other measures you're going to see here soon. Next, we have the T12 or trailing 12 months net operating income. These are the prior 12 months. It's not a calendar year, although it could be, but because we're kind of in the middle of a year here, July 2019, it's going to fall in the middle of the year. So we have July 2018 to July 2019. As you see here, the trailing 12 does capture the increase in net operating income in the later months, but it also captures some of the lower net operating income from earlier periods. And finally, we have calendar year 2018. This captures an entire calendar year, and the most recent taxes would probably reflect this. But as you can see, it only captures lower net operating income. It doesn't capture the full effect of the improvements that were made in the more recent months. So if you were to calculate a cap rate based on the net operating income from each of these periods of time, where calendar year 2018 probably has the lowest net operating income, T12 has a little bit higher net operating income, and T90, where you take only the most recent 3 months, which all had high net operating income, multiply that times 4, here's what the cap rates could look like. And what you would see at a property where improvements have been made over the most recent months. Even though it's not reflected over a full period of a year, you can see an improvement. So based on a sample of 12 months, or maybe 3 months multiplied times 4 to get 12 months, you can look at different periods of time to see if there's an improvement in operations of the property. And that's pretty clear right here. If you're a seller and you made improvements of the property, but they're not reflected in your tax returns or over the last 12 months, try to get someone to buy on your T90. You might not be able to convince them to do it, but if you can, you're going to make out a little bit better. And those were our backward-looking cap rates. Next, we have the in-place cap rate. In-place cap rate is exactly what it sounds like. It's the cap rate that's in place when you buy the property, right then and there. It's based on existing rents. It's based on existing expenses. And it's the cap rate you're stepping into. It's already there. And then the next type of cap rate is your pro forma cap rate. And this starts to get more into a financial projection. This is a cap rate based on the net operating income for your first year of ownership. You make an estimate for how much NOI you're going to receive in the first year of ownership, and you calculate your cap rate based on that. So let's fire up Excel again and see what this looks like in action. You don't need to know Excel. This is just for display purposes. So here you have your in-place net operating income. It's what's happening right now, the very moment you step into the property. And let's say that the purchase price is $315,000. Divide the net operating income by the purchase price, and it's a 6.98 cap. Very simple, straightforward. To the right of that, though, we have pro forma. And as you see here, we forecasted an increase in income. Maybe we're going to raise rents when we buy the property. This is our projection of what we think we can do next year while we own it. And looking at expenses, we forecasted maybe a small inflationary increase in expenses, because typically expenses go up a little tiny bit every year. It's called inflation. You've heard of it before. And then you have an increased net operating income at the bottom. So when we go and divide that net operating income by the purchase price, we get a 7.34 cap. It's higher because we're forecasting more net operating income. And one of the reasons why it doesn't hurt to look at both of these when you're buying a property is that you can see how aggressive you're being in year one. If this went from a 6.98 cap to a 10 cap on your pro forma, that might give you an indication that maybe something's unrealistic about your forecast. And maybe you want to revisit your numbers. It could be right, and that could be what happens, but maybe you made a mistake in your math, or maybe you're just getting too aggressive in forecasting something. So that's a reason why you might want to look at both of these when you're buying a property. The last thing I want to cover is what a stabilized cap rate is. On the screen before you, I'm using Excel again. It's only for display purposes. Don't get concerned if you don't know Excel. I created a 3-year projection here. And the most important thing I want you to see here is the income. It starts out in year 1 at $30,000. It increases in year 2. And in year 3, it stabilizes at $45,000. You probably picked this out based on the way I use the word stabilized. But a stabilized property is one that is operating about as efficiently as it's going to operate. And then you can also see your expenses for each of those years, each year increasing a little bit with inflation. And then you see the net operating income at the bottom there. The net operating income increases pretty drastically, $7,000 to $16,000 in year 2 and $20,000 in year 3. And in year 3, if we finally get all that extra value we're supposed to get at the property, we can consider that stabilized. So our stabilized NOI comes in year 3 in the amount of $20,599. This begs the question, why was the income so low in year 1? I don't know. This is just an example. Maybe there were a few units that weren't rented out. Maybe there was excessive vacancy here. There's a reason for it. In order to achieve that increase in income and ultimately the net operating income, it's probably going to take some additional money. And you can see that right here. In year 1, we invest $35,000 over the purchase price. And then in year 2, we invest another $40,000 over and above the purchase price and the amount you invested in year 1 as well. So that's $75,000 additional investment to go from that $30,000 in income to that $45,000 in income. Let's skip the additional investment for now, and let's just calculate the cap rate as we've traditionally done, net operating income divided by purchase price. And here are the cap rates for each of those 3 years if you're looking forward. In year 1, your pro forma cap rate is 3.89%. In year 2, with that increased NOI of $16,000, your cap rate is 9%. And in year 3, at your stabilized net operating income of $20,599, it's an 11.44% cap rate. Now, these cap rates were calculated based on the purchase price. So if you're looking at a property and the seller or the broker tells you that once you get the income increased, you're looking at probably an 11% cap rate on the property. That sounds great, but that's only part of the picture because we really didn't take into account that additional investment of $75,000 that we need to get us to the stabilized net operating income. So at the bottom here, here's a little analysis showing you how to calculate a stabilized cap rate inclusive of all the additional investment needed to get you there. We take the stabilized NOI from year 3, we divide it by the total of the additional investment and purchase price, which is $255,000, and that gets us an 8.08% cap rate. So when you look at the bigger picture and all the money you're putting into the deal, purchase price and the additional investment, you're looking at a stabilized cap rate of a little over 8%. So when that broker tells you it's going to be an 11 cap after you get the income up, you can turn around and say, nope, it's an 8 cap after I do all that work and after 3 years pass. And then you can try to negotiate the price down. But that's stabilized cap rate. So what's the ideal scenario for cap rate? Well, as we just saw, it works best when the property's stabilized already with long-term predictable net operating income and no immediate capital improvements needed. Basically, the property's operating about as efficiently as it's going to, and you're going to continue to operate it the exact same way moving forward. The least useful scenarios for cap rate are when there's above or below market rents. If the net operating income, for whatever reason, income or expense changes, if that net operating income goes up or down in future years, cap rate's not going to be as useful because you're only looking at 1 year. You're not looking at all the years. And in that same sense, temporary and short-lived income temporarily or for a short term impact net operating income. So that basically suggests there's going to be a change in net operating income at some point in the future, and that may or may not lend itself to a cap rate analysis. We've been talking about net operating income from the property, which is basically the income produced by the property as it operates as an ongoing business, but we didn't talk about selling the property in the future. What if the property value increases significantly or decreases? None of this stuff is captured in cap rate. And as we mentioned before, it's also not very useful when the property needs capital improvements. When you go and research cap rate comps, you only see the recorded purchase price. You don't see the additional money they put into the roof or the additional money they had to put into the structure if they had to do that. It's missing ingredients. And before we close this section out, I'm going to talk to you quickly about cap rate versus cash on cash return. These two things are very, very similar, and believe it or not, can be the exact same number if you buy a property all cash. We'll go into a deeper conversation about cash on cash return and how it compares to cap rate in the cash on cash return masterclass. Look for that on our website. And in closing, to quickly recap, cap rate measures the profitability of the property as an operating business. It's the return the property generates on the purchase price. It's property specific, has nothing to do with the investor. It's all about the property, the net operating income it produces, and that measured as a return on the purchase price. As you saw throughout this course, cap rate is messy. People calculate it differently all the time. You might even calculate it differently from property to property. I'd highly suggest creating your own database of records. Whenever you get property information, go through the process of calculating the cap rate yourself, and then hold on to that information so you can refer to it someday down the road when you're looking for comps. As you look at cap rates in the market, don't always expect to find meaningful insights. You might not. Hopefully there'll be some insight you can mine out of the comps, but my guess, if you're looking at a property with 4, 8, 12, 18, 20 units, you're probably not, at least not all the time. If I could suggest a next step to you now that you've gone through this cap rate course, if you haven't already done so, go and complete the How to Value Rental Properties Like a Pro course. Even if you don't use what you learn there, you'll have a deeper insight into how pros actually make decisions. And that'll be one thing you can check off your list of things you don't know about. There's this old saying, you don't know what you don't know. Well, this is something you probably don't know that you don't know. So go check it out.